Hi, everybody. Happy April. If you remember, Sean and I, last monthly market insight, we talked about how geopolitical crises may affect the markets. And so certainly, there's still a war going on in Ukraine when Russia went to invade Ukraine. So we've gotten a lot of questions on that. Just kind of a friendly reminder of that monthly market insight. It is recorded. So I recommend you going back to that recording. It's on our YouTube page. If you have any questions on how maybe the war, how past geopolitical crises has affected the market, certainly can't predict what's going to happen in the future, but we use that as a reference. So please go back and look at that recording. We'll kind of maybe touch on it a little bit today because we're still getting some questions, and you're of course hearing it on the media a little bit. But first, let's kind of dive into some top questions that we received. First being the yield curve, Sean. So can you kind of give us some information on, what does the yield curve tell us? Should we be concerned that it inverted or part of it inverted last week? So tell us how that impacts us as investors.
Yeah, so the yield curve inverting is very important. The reason is because a inverted yield curve has accurately predicted a recession for each of our recessions since 1955 with only one false indicator. So that's why it's a little bit scary. Now, it doesn't say when, but historically it's been about 6 to 24 months after the yield curve goes inverted is there a recession. However, there's a caveat to that, right? So the yield curve must remain inverted for an extended period of time. One of the studies I read said about 10 days before that actually leads to an indication of a recession pending in the next 6 to 24 months. So we saw the yield curve inverted last Thursday, and then it went back to kind of normal. The reason that's important, right, and what that means is our government issues treasury bonds so that they can pay their obligations, and they'll issue them in 2-year increments, 10-year increments, 30-year increments, 2-month, all sorts of different increments. Well, what we look at is investors expect to get rewarded. They expect to get a higher coupon rate from the government when they buy a long-term bond, so a 10-year bond. So they want to get paid more from their dividend, their coupon, if they hold it for 10 years than they do if they hold it for 2 years. There's more risk associated with that. So historically and normally, the 2-year treasury bond will pay a lower interest rate than the 10-year. And so what we're seeing, and we saw last Thursday, was that the 10-year actually paid less than the 2-year, which means investors expect in the near term the Fed to raise interest rates, which is nothing kind of abnormal. The curve has been flattening for a while due to inflation. And so as we hear the Fed announce that they're going to be making changes, we start to see this flattening happen, and eventually we start to see an inversion. So we saw that temporarily, and that's kind of what the big news was about. And it is something that we should absolutely monitor. Okay, so if we do see this inversion last for 10 days or longer, if it's accurately predicted every recession since 1955, with only one false indicator, it's certainly something that we want to be observing. So we will stay tuned to that and how that progresses. We know that the Fed will be raising interest rates. We know that those things are coming. And so watching that yield curve inversion is very important.
Thanks, Sean. And you talk about interest rates. One thing that we'll kind of be monitoring this week is if any comments from the Fed on, how large those interest rate hikes may be. I know they talked about last month being 0.25%. So kind of how often and how high those interest rates are, again, going back to trying to reduce that inflation.
Yeah, and really what we've been saying all year long is, that's the biggest indicator, the biggest thing that we're watching in the news is yield curve inversion, what the Fed's going to do with interest rates. We saw the first quarter be negative, right? As of the start of this morning, the S&P was down about 4.2%. The NASDAQ was down a little bit more than 8% for the year. So a lot of that was because the market was trying to predict how much is the Fed going to raise interest rates. And so once the Fed announced that they will be raising interest rates, but it's not going to be anything drastic, they're going to try and do about 6 for the year. They're going to raise about 0.25% per time. the market said, wow, that's good news. We priced in a bigger correction. So we started to see the market really ever since the middle of March there move in the positive direction. So it's gained about 5% back just in that time. And we still believe that by the end of the year, the market will be positive. Again, trying to predict the future, which we're not good at, but we still think that will kind of be the case. So yeah, we're watching rising interest rates very closely. On Wednesday of this week, the Fed is going to come out with their meeting minutes from that meeting there in March. And the reason that's important, it's going to give us a little bit more detail about what some of the thinking is long-term, structurally, how the Fed wants to get this done. And so the market will have a little bit more information about how the Fed plans to raise interest rates. And when the market has more information, it's better able to kind of take into account market predictions, if you will, so they can adjust the prices accordingly. So it'll be a good news bite this Wednesday. And then next Tuesday, April 12th, is the next time that we'll see the CPI number come out, right? The consumer price index has been moving steadily. That's the reason that the Fed is raising interest rates. So if that number continues to be higher, and some of the trends that have happened, 7.9% last month, 7.5% the month before that, 6.8% the month before that, we keep seeing consumer price index move higher. If it gets into the 8s, if it gets even higher than that, then we're going to start to see the market say, hey, Fed, you better start taking into account higher interest rate hikes or more of them. And so all of that information is going to really play out how the market moves over the next couple of months and throughout the remainder of the year. So some good information coming out this week and next. But we've had some great information, right? So unemployment's at 3.6%, extremely low, right? Better than expectations. Again, we keep saying the Fed has the ability to raise interest rates because we have a really strong economy. Inflation being at 7.9% for the last month means consumers are spending, right? When consumers spend, companies make money. We saw a great jobs report last month, 750,000 jobs. This last month in March, we saw 431,000 new jobs added. So we continue to get great jobs reports numbers, with the most kind of additions being in some of that retail, travel, leisure, a lot of those activities, which again is consumers spending money, right? I've got excess money. I'm going to do some of that traveling. I'm going to buy some more clothes, whatever it may be. And so as people spend more money, the economy does really well. Also, consumers at the end of 2021 had really, really low credit card balances. In fact, lower than prior to kind of the coronavirus recession. That made a big change the last quarter, right? So we're starting to see consumers take on more revolving debt, more credit card debt, which again is an indication that people are spending money, and that's why companies' earning reports have been great. Again, people are getting hired because companies have money. All that leads to a really strong economy to allow the Fed to raise interest rates to kind of normalize things.
Thanks, Sean, for that. We talk about raising, the inflation rate, cost of goods are increasing. Another thing that we obviously all felt is at the gas, right? We saw the prices in gas increase. So recently, last week, President Biden opened up the oil reserves. And so some of the kind of chatter we're hearing just with investors kind of goes back to some of the sanctions and things that are happening in Ukraine. So Sean, can you kind of tell us just generally, what are sanctions? Why do we employ those? What kind of effect does that have on us at home as well as in the markets?
Yeah, so all that's really hard to kind of predict, right? So that's a lot of macroeconomic discussion. How long, right? I don't know enough about the oil and gas business to say, hey, if we open up oil reserves, you're going to see a decline in prices within the next week. I don't understand the supply chain well enough. But ultimately, what the government's trying to do is put some, pressure on Russia to pull out of Ukraine. That's the point of the sanctions, without putting our military, getting too involved there. So that's kind of the point of it. And then Russia supplies a lot of oil to Europe. But one thing that we keep kind of discussing and talking about is, Russia makes up a very, very small percentage of the world's market valuation, right? So what happens in Russia is not going to have as drastic of an action on the market as if we had something happen in China, right? There's going to be a much larger influence if something like that happens. So yeah, certainly something to watch and think about, but ultimately we believe it's all political discussion, right? People to kind of attack one another and kind of get their own political agenda across. we'll see how it all plays out. I think if consumers continue to spend money, and oil and gas companies will continue to make money, all other companies will continue to make money, and it'll all work out for the market. But as inflation data comes out, that's a big part of it, right? And people are feeling that pinch at the pump, making different decisions, and some of those things could, over the long term, impact the market if people stop spending money on retail and leisure and travel because they don't have as much excess money. That could be a problem. But one of the things that I keep telling people is people are spending money, and people ask me, where are they getting this money? Kind of the greatest thing that we've seen over the last couple of years is really real estate, right? So everyone's got more money in their home. They will take that money out of their house by doing a home equity line of credit. They'll refinance their house and get some of that cash out and go spend it. How long that lasts, we don't know. But that's a lot of places. That's a lot of the reason people are getting money. Their net worth is increased, just by them sitting at home. So that's a lot of where people are getting money and how the economy continues to push forward.
Appreciate it, Sean. I recently read, I think it was a statistic on homeowners, and in the past year, most, Gen X and Gen Y make up majority, a lot of that younger population making majority of new homeowners, right? COVID happened, not going to work, trying to settle down, things like that. So I know a lot of younger professionals are getting into the mortgage, the market as well. So any other questions, please send those in to Sean and I. We'll keep you kind of posted on some information that comes out this week from the Fed, as well as early next week in terms of CPI or inflation number. If you have questions, again, reach out to us. We're here as a resource.